The word credit is a word that, if understood, will give you the life that you want. It'll free up more cash for you today, leave more in your pocket in the future, and unlock opportunities to a successful life no matter what that looks like for you. My name is Levi Wolf. I'm an active duty Marine, and for the last 3 years, I've helped service members and small business owners fix their finances. Now, if you're in the military, you've definitely heard of Lance Corporal Schmuckatelli that went out and got a 20% loan on a brand new Mustang. And I see these mistakes more than I'd like to admit. So today I'm going to go over the 5 things that you need to know about credit and debt so you can stop wasting money on interest and skip all the mistakes that tons of other people make. And at the end of the video, I'll show you how I helped my Marine fix his nearly 30% APR auto loan and how I managed to get less than a 5% interest rate on a beautiful Mustang myself. So to start with point number 1, I first want to get this out of the way and say that debt itself is not bad. It depends on what the debt does for you. For example, if it takes money out of your pocket, like high interest car loans, credit card debt, and personal loans, that's consumer debt and it will eat away your financial potential. But if the debt puts money back into your pocket by helping you expand your wealth, like real estate investment or inexpensive financing that allows your cash to stay invested, that's productive debt. Productive debt makes you money and consumer debt costs you money. So how do you know when you should actually take on debt? The simple answer is when your money can do a better job somewhere else. So let's say that you have $25,000 sitting in the bank and you want to go buy a car. Now you could pay for that car in cash, or you could go to the bank and let's say get a car loan for a 3% interest rate. What that does is it frees up your $25,000 to then go and invest into an asset that let's say returns 10%. And here you would earn the difference between the two, which would be 7%. And that is called arbitrage, where you can go and you can leverage cheap debt so your money can go and work harder for you. And one of the best examples of productive debt, especially for people who want guaranteed growth, is borrowing against an asset that keeps growing even while you use the money. Like for example, borrowing against the cash value in a whole life policy. For example, in a whole life policy, if you had $25,000 in there, everyone knows you can borrow that money and you can go get a cash flowing asset, that's a house, or you can go buy a car while you still have your full $25,000 growing with all the interest that's associated with the policy. So even while you're using that money elsewhere, your cash value keeps compounding, and that's how you can use your debt to actually make you more money. Now in that case, credit doesn't even matter because you're borrowing against your own money. But once you step outside of that and start using a bank or credit card, the game changes. And that's where credit comes in. And it's what decides whether you even get access to money in the first place. So let's break down how credit works. Credit is just your financial reputation, and it's how lenders judge whether or not they can trust you with money. And credit matters because the higher your credit is, typically the less you'll pay in interest, which means more of your paycheck stays in your pocket. When we look at credit, lenders are basically asking one question, which is how good are you at keeping your promises when it comes to paying back money? And all this is put into a credit score, which is made up of 6 different components. So I ordered these from the largest impact to the lowest impact. And the first thing that's gonna be the highest impact is going to be your payment history. So for your payment history, this is the biggest thing that they're looking for. This is, do they pay on time and how consistent are they with that? Missing a payment can stay on your record for as long as 7 years, and that's pretty much the most basic thing, just making sure you pay your bills. The second thing that they also look for is credit utilization. Credit utilization means that let's say you have 2 cards that both have $5,000 on it for a total of $10,000. All this is credit utilization is how much of your available credit are you actually using. They see that if you use all that available credit and if you're using everything, then you're a higher risk. So what they want to see is usually no more than 30% utilization. So if you have those 2 credit cards, each with a $5,000 limit and a total of $10,000 of your overall limit, then they wouldn't want to see any more than 30% of that, which would be no more than $3,000. The next thing that goes into your credit score that does have a high impact is going to be your history of credit. So here they're looking at the length, how long you've actually had open lines of credit for. Because if you compare someone that's had a credit card and had all this history for 10 years, they know the ins and outs of credit, they're going to be a lot more trustworthy and reliable compared to someone who just got a credit card yesterday. And here they look at the averages of all your accounts. So the biggest thing is that you want to have a long history of credit, which is why if you, let's say, close a credit card or you close an account that had a large history of credit, that can negatively impact your score. The next part of your credit score is going to be your types of credit. For your types of credit, there's different kinds. There could be credit cards, there could be mortgages, there could be personal loans, auto loans. All these different kinds of lines of credit are going to impact your score differently. This one's actually really interesting. What I've seen is someone who only had an auto loan on the record, and we're trying to help this person buy a house. So when we looked at the credit, it was about 650, and they've had an auto loan on there, and they've been making their payments consistently for about almost 2 years. So their credit score should have been high, but like I said, it was only about a 650. And so when I looked at that, I realized that they didn't have a credit card. So we opened up a credit card, and just from going from a car and nothing else to a car and a credit card, their credit score went from a 650 all the way up to about a 730, which means that when we looked at going to buy a house and getting a mortgage, they went from getting mediocre rates to now getting the best. All right, number 5 of what goes into your credit score is going to be credit checks. All right, now credit checks is any time that you go and you apply for anything to do with credit, like you go get a new credit card, you try to buy a house and get a mortgage, or you get an auto loan. Anything you do before you get that loan, they're gonna do a hard credit check, and that's typically gonna ding your credit a couple points, and that's because the lenders will see, hey, if you're trying to go and take on more debt, you could be temporarily seen as a higher risk. So that's why it'll momentarily drop just for a couple months. We usually hear if you're gonna go and let's say I'm gonna go get a mortgage and I wanna go shop around from different lenders. And I go and I look at 4 different lenders, and if they all do a hard credit check within the same time frame, whether that's 2 weeks, 4 weeks, whatever it is, usually all those credit checks, even though it's from other people, because it's in the same time frame for the same product, they can all be bundled as one check. All right, and the last thing that goes into your credit score is going to be what's called available credit, your available credit. So if I have 5 different credit cards and they all have a $10,000 limit over 5 credit cards, that means my total available credit is going to be $50,000. And the reason that's going to help is because, again, it all ties back into that credit utilization. The higher available credit you have and the lower that credit utilization is, the more it's going to help your credit. So whether you struggle with this or you're already doing well, at least now you know why your lenders treat you the way that they do, and more importantly, how to fix your score if it's not where you want to be. And if you want to know where your credit is specifically, most bank apps have a place that you can go and look at it. But you can also get a free credit report from the big 3 credit bureaus once each year. And I put the links for them in the description below. So now that you know what credit is, let's talk about the main thing that actually builds it, which is credit cards. Credit cards are revolving lines of credit that let you borrow the bank's money. And here's what that actually means. The bank gives you access to a certain amount, say $5,000, but you only pay interest on what you use. So if you spend $500, you'd only pay interest on that $500, and when you pay it off, that money becomes available again. That's what revolving means. It's like a reusable loan that resets every time you pay it down. But now here's where people mess up. They see a $5,000 limit and they think that it's their money, but it's not. Remember, it's borrowed money, and the bank expects it back within 30 days. If you don't pay it off, then you're gonna be hit with 15 to 30% interest on top of that. And that's how people just get buried in debt. But here's the thing, credit cards aren't bad. They're actually powerful tools if you understand how they work. The problem is that most people just never learn that part. So a credit card isn't just a piece of plastic. It's a part of a financial system that rewards the bank for letting you use their money and rewards you if you play the game right. So most people think that the bank only makes money with the interest that they charge you, and that's definitely one way, but there's more going on behind the scenes. Banks also earn money every time you swipe your card. That's usually referred to as a swipe fee, which is about 2 to 3% of your purchase paid by the store that you're buying from. And that's why stores sometimes charge extra for credit card payments. And it's also why your card will offer you 1 to 2% cash back, because you're basically splitting the profit with the bank. They get paid by the merchant and you get a cut using their system. So if you're smart, you can earn rewards, build your credit history, and protect your money without paying anything in interest. So just stick to the golden rule and treat your credit card like a debit card, paid in full every month. There's literally zero benefit to carrying a balance. You're just literally throwing away money in interest payments. Now, if you're skeptical and think, wait, I don't have to actually leave a balance, here's how it actually works. So let's say on January 1st, you go and you put $1,000 on your credit card. The bank probably isn't going to report that to the credit bureau up until, let's say, January 20th. But at the same time, they're not going to be expecting that payment up until, let's say, February 5th. So that $1,000 goes, it gets reported to the credit bureau. Now it's on your credit report, but you go and let's say you pay it off on February 1st. Even though you paid it off, you're not going to pay any interest on it because it was before the 5th, so you're not paying interest on it. But the credit bureau still got that report, and it's going to go and then update on February 20th once the bank sends the second report for that next month, and then it'll go and it'll update what's down here with the new number, whatever that is. But from here, you can see that even though you have stuff reporting on your credit, doesn't mean that you're going to be paying interest on it. It all depends on making sure that you pay it off at the end of every month. So which credit card should you get? I look at it like this. There's two kinds of cards, those with annual fees and those without annual fees. Automatically, the baseline best choice is one with no annual fees. That's an easy one. But now for cards with fees, you just have to do the math. If a card costs $800 a year, are you realistically getting more than $800 of rewards or perks back? And if not, then it's not worth it. If you're active duty military, this is where it starts to get interesting because some premium cards like the American Express Platinum Card or Chase Sapphire Reserve usually have fees around $800 a year. But for active duty members, those fees are waived. But for veterans though, they're not. So here's something that most people miss. You can't downgrade those cards to no fee versions without closing the account, which shortens your credit history, which is something that you don't want to do. Meaning if you don't plan on keeping those cards after you EAS, they might actually hurt your credit in the long term. So again, start with cards that don't have annual fees and know how to manage your interest payments. Interest payments. This is something where most people's eyes glaze over, but if you stick with me for 2 minutes, you'll understand why people pay double for cars and houses without realizing it, and more importantly, how to avoid being the guy who falls for it. Hey, real quick, if you have over $20,000 saved and you hate just having it sit in your savings account, wasting away to inflation, or you know that you could just be doing more for yourself, I'm currently taking on new clients. And if you'd like the opportunity to learn and set yourself up financially for free, click the link in the description, hop on a call to see if you qualify. And if the specific calendar link is still there, then it's still available. So now let's get back to talking about how to save and make money with interest. Interest is what you pay to borrow money. So if you think of banks, their business is to sell money in the form of loans. And you as a consumer, you buy that money and pay interest. But here's where most people get trapped because there's a huge difference between what you think you're paying and what you're actually paying. So the first way that interest is calculated is something called APR or annual percentage rate. And APR is like the speed limit on your loan. It tells you how fast interest can build and exactly how much you'll pay. So imagine you have a $10,000 loan at a 10% interest rate. Every year, you know you're going to be paying $1,000 on that. So that $1,000 is what you'd be paying assuming you never paid any of that $10,000 off throughout the year. Now that $1,000 assumes that we didn't pay anything off of that $10,000 throughout the year. By the way, here's how that would work. We have the 10 grand at a 10% interest rate, and then we divide by 12 because that is going to give us how much interest we actually pay monthly. And here, let's say I think that's about $83. But then let's say the next month we go and we pay off $300 on a loan. So now we have 9.7 thousand times 10% divided by 12. And let's say that's about $81. And then the next month we pay $300. Same thing here, 9.4 thousand, 10% divided by 12. Let's say that's probably about $79. And then that all the way throughout the end of the year is the real number that you pay in the APR. So the APR isn't the exact number you'll pay, right? That $1,000. Rather, it's like the speed limit. It tells you how fast your debt is growing and lets you compare loans side by side. Because if one loan is 6% and one is 10%, you'll instantly know which one's cheaper. but your real cost depends on how fast you pay it down. Now that's APR, which is the cost of borrowing. On the other side of the coin, we have APY, which is annual percentage yield, and that is your return on growth. You'll see this for savings accounts and investments, and that's how much you'll earn in interest, not how much you'll pay. So for example, if you have a savings account with $10,000 in it, and it's earning a 5% APY, in a year, you'll net $500. And to find out how much you're actually going to get per month, again, you take that $500, divide that by 12 to get roughly, and then from here you'll get, what is that, about $42 or so? That's about how much you'll get per month. So now that you know what interest is and how it's calculated, the next logical question is, especially for a cost, is there any way to pay less of it? And if you're in the military, there actually is. And that's where the Service Member Civil Relief Act, the SCRA, and the Military Lending Act, the MLA, come in. These laws are designed to protect you financially while you serve, especially when it comes to interest, credit cards, loans, and predatory lenders. Now, the SCRA mainly applies to debt you had before you joined the military. And let me give you a real example of how crazy this is. So I was at SIF the other day and bumped into a PFC who joined with $40,000 in toxic debt at an 18% interest rate. So to pay that off, he'd be paying about $1,000 a month for 5 years, paying $21,000 just in interest alone. Now, the SCRA would reduce all of your interest rates to 6% if it's debt you got before you joined. And in this case, that same PFC, if he made the same $1,000 a month payments, it would take him just under 4 years now, and he'd only pay about $5,000 in interest. Overall, that saved him $15,000 in payments. Now, the Military Lending Act is for active duty service members, and it has a hard cap on interest rates set to 36%. So if you're active duty and someone tries to sell you a payday loan at 300% interest, the MLA will cap it at 36%. It's basically the government saying you're serving, so we'll make sure nobody screws you over financially while you do. So yes, the military protects you from predatory interest, but that still doesn't mean you can't make mistakes. Now, here's a real example of my Marine and how he saved $7,000 on car payments in a month while he was on active duty. So he comes to me, and initially he told me that he had an 18% car loan, and I thought that was pretty crazy because I thought he was talking about his credit card interest. So I said, hey, next time you see me, make sure you pull up those real numbers so we can actually see what we're working with. Now, the next time I saw him, we checked, and it was actually 29.16%. And as crazy as it seems, no amount of belittling or name calling is going to fix that. So I decided to actually fix it, and here's how we did it. It took a little bit of thought. So we obviously decided to refinance the loan, and I know that Navy Fed would probably give him a 6 or 7% interest rate. But the problem is that he had low credit. He didn't have late payments or anything, but turns out what he had was a credit card, which is good, but it had a $500 limit. And normally he kept about $300 on the card, paid off every month, but it still kept that, just always around $300. But that means that his credit utilization is way over that 30% that we want to be. And I was like, that's probably what's keeping your credit low. So immediately what we did is we opened up his bank app and we requested a larger limit on that credit card. So we went from $500, we bumped up to $1,500, and that reduces credit utilization all the way to about 25-30%. And so his score shot up, he refinanced the loan, and as you can see here, he went from paying what would have been $9,000 in interest over 5 years to under $2,000, saving him more than $7,000. Don't forget, I said at the beginning, I'd tell you how I got under 5% interest rate on my Mustang, so here's how. I have good credit.